Alrighty, let's get straight back to Mark Matthews, now equity strategist at Macquarie Capital Securities. Mark, right before the break we were chatting about whether or not soft commodities are in fact the new oil, and it appears that at this point it doesn't look like they are. However, when you look at your strategy, a particular stock pick that I know that you like, and that's a retailer in Thailand, the Big C Supercentre, was based on the fact that Thailand was one country that would benefit from a trend like that. Is this still on your buy list?
Absolutely. But I would say that, I'm very bearish until oil goes down for any stocks. But if I was going to buy stocks, then this is a great one. It's actually already down 20% from where it was at the end of last year. So you've had people selling it as they generally repatriate money outside of Asia, given the heightened risk premium. But anyway, the story is that Thailand is just a fabulous play on soft commodities. I can't think of any better one in Asia, because they're the largest exporter of rice in Asia, in the world, and they're the largest exporter of rubber in the world. And rubber, which cost, I think it was 30 baht a kilo 10 years ago, is now 170 baht a kilo. So you can imagine the kind of impact that's had on farmers' incomes. In fact, I did a back-of-the-envelope calculation. I think that the average rubber farmer in Thailand is now making about $45,000 a year after his expenses. So these are people who actually have very sizable incomes now compared to what they did before in what they call upcountry Thailand. And Big C is a really great play on that, because Big C has about, I think, 45 stores in upcountry Thailand. And they just bought Carrefour in November last year, which is adding another 20-odd stores. So as these people in Thailand, these upcountry people, have more and more money to spend because of these high prices of soft commodities, they're going to go to places like Big C to buy things.
We're at about 75 right now, Mark. What are your levels for this? Because when you look at the PEs, 15 times this year, dropping to 13 times this year, so not hugely expensive.
Yeah, so actually I think the stock should be valued on a DCF, and if you apply, well, we have a DCF which is 40% higher than the current share price. The stock also, I should say, the people didn't like the Carrefour acquisition because it was quite a high price. And Carrefour's margins are only half those of Big C. But what you should know is that Big C is part of a group called the Central Group. And if you've ever been to Thailand, Bangkok, you may have noticed Central department stores. So that's one part of their big group. But they have Robinsons and Watsons. They have many, many stores in Thailand, and Big C is one of them. So I guess my point is that the Central Group's bargaining power with its suppliers is very, very high, probably better than any company in Thailand. And so as Carrefour gets integrated into the Big C chain and the Central Group chain, its margins will go up. And already we're hearing from suppliers that they're having to pay higher prices to get their products on shelves.
Okay. Alrighty. Interesting company to chat about, Mark. Thank you for your time this morning. Good to see you once again. Mark Matthews.